Internal Revenue Service IRS tax news. How the CARES Act changes deducting charitable contributions. COVID tax tip 2020-153, November 12, 2020. Whether taxpayers are supporting natural disaster recovery, COVID-19 pandemic aid, or another cause that's personally meaningful to them, their charitable donations may be tax deductible. These deductions basically reduce the amount of their taxable income. Here's how the CARES Act changes deducting charitable contributions made in 2020. Previously, charitable contributions could only be deducted if taxpayers itemize their deductions. So let's just break this down real quick in terms of what groupings of deductions we have. First, we have deductions for adjusted gross income. These used to be called above-the-line deductions, possibly now called Schedule 1 type of deductions. And you can think of these type of deductions as similar to being a decrease of the income, meaning not as much a deduction, or possibly you could think of it as part of the decrease to the income line because they're a deduction for adjusted gross income. You deduct them to get to the line item of adjusted gross income. So although they're basically deductions, you can think of them as kind of reducing the taxable income. And then you have the below the line deductions, or the Schedule A type of deductions, or the playoff between whether you're going to take the itemized deductions or the standard deductions. In other words, the other two groups of deductions, you take one or the other, either the standard deduction or the itemized deduction. Standard deduction is going to be easier because it's going to be standard just based on your filing status. Itemized deduction then means that you're going to put the deductions together that would fall into this itemized category. And if those itemized deductions are greater than the standard deduction, then it would be beneficial for you to do that. Now, more people now kind of fall into the standard deduction, or that's where the tax law has been leaning towards lately in an attempt to simplify the tax code, which would mean we would have less on the itemized deduction side, which is one of the more complex portions of the tax code, and have more people that would just be simply taking the standard deduction. Now, part of the result of this is that the itemized deductions traditionally have been on the itemized deductions include charitable contributions. In other words, the charitable contributions traditionally have been included in the itemized deductions on Schedule A, which would only then be benefiting people if they contributed to the total itemized deductions in such a way that it would increase over the standard deduction. So anybody then taking the standard deduction most likely would not have before get a tax benefit, or traditionally get a tax benefit from the charitable contributions. So that's the general rule. Now back to the text. However, taxpayers who don't itemize may take a charitable contribution up to $300 for cash contributions made in 2020 to qualifying organizations. For the purposes of this deduction, the qualifying organizations are those that are religious, charitable, educational, scientific, or literary in purpose. So you want to make sure when you're contributing to an organization, you want to make sure that it is a charitable organization, a good organization. And if you find an organization that qualifies for IRS exemption or tax deduction, then that is an indication that it's a qualified charitable organization, or one of those kind of qualifications. You probably want to do more research just to make sure your money is going to a good organization, however. So the law changes in this area due to the Coronavirus Aid, Relief, and Economic Securities Act. The CARES Act also temporarily suspends limits on charitable contributions and temporarily increases limits on contributions of food inventory. More information about these changes is available on IRS.gov. Here are some resources for people making donations. Tax-exempt organization search. So you have a link to the tax-exempt organization search. Remember, anytime there's kind of a problem, like there's been a kind of a weird year, there's people that might be scamming, and they might use charitable organizations as a way to scam. So you want to give during this time. This time would be beneficial, but you also want to make sure to do the research to give to the right places so that your money is having some good. So taxpayers must give a qualified organizations to deduct their donations on their tax return. They can use this tool to find out if a specific charity qualifies as a charitable organization for income tax purpose. Publication 526, Charitable Contributions. There's a link to that here. This publication explains how taxpayers claim a deduction for charitable contribution. It goes over how much taxpayers can deduct, what records they must keep, How to report contributions. Publications 561, determining the value of donated property. Taxpayers generally can deduct the fair market value of property they donate. This publication helps determine the value of donated property. So when you donate something other than cash, then of course you have the problem of valuing it to see what the deduction would be. So this will help with that valuation process. Form 8283, non-cash charitable contribution. There's a link to that here. Taxpayers must file Form 8283 to report non-cash charitable contributions if the amount of this deduction is more than $500. The instructions for this form walk taxpayers through how to complete it. Schedule A, itemized deductions. There's a link to that here. Taxpayers deducting donations do so on Schedule A. So Schedule A is the itemized deduction schedule. The instructions for this form include line-by-line directions for completing it. Frequently asked questions. Qualified charitable distributions. Link to that here. Taxpayers of age 70 and a half or older can make a qualified charitable distribution from their IRA up to $100,000 directly to an eligible charity. It's generally a non-taxable distribution made by the IRA trustee to a charitable organization. A QCD counts toward their minimum distribution requirement for the year. So this is a way that you can pay out of the IRA directly to a charitable organization and possibly get a tax benefit from that, because obviously normally when you take money out of the IRA, it would be a taxable income type of situation. So more information, tax topic 506, charitable contributions, deducting charitable contributions at a glance. There's a link to those items here. There'll be a link to this in the description.